Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Welcome back. It's been a whole week. Oh, you know what? I need to get the music started. See, I'm already out of practice. Words like no live session. No, that's we've had it scheduled all week. We're doing it. We're doing it. I hope you guys missed me. I missed you guys. But you know what? I had a blast developing too. Well, let's come in and look at the charts, see where we're at. I guess we kind of have to consider the whole week. So remember this big jump up here was the non-farms payroll. And, you know, it's actually kind of been an uneventful week in many respects because it's mostly just been flagging. There is this little man. What was it, Wednesday? Was it Tuesday or Wednesday? I guess it had to have been Wednesday. There was like a change in the probabilities of who was going to become Fed president, and some robot went haywire or something, and that was something. Yeah, that one was crazy. Let's see here. S&P 500 also kind of reeling from the jobs number Friday, but they seem to be recovering okay, right? Oil coming down there. Gold. Okay, so today in gold, we are finding out that tariffs against Switzerland will apply to gold. So that's kind of a problem. And it could spike the price of gold and do crazy things. We'll see. Silver. Well, silver and gold are still very different these days. Copper. Man, okay, so we had the thing from copper. Oh yeah, there's gonna be tariffs. Oh, but it doesn't apply to copper. And now it's just kind of we should just change the chart to be like that. Now you can actually maybe see what's going on. I don't know. That's so crazy. With copper, the chart is still messed up. Okay, and then we've got the Japanese yen and the dollar. So again, everything just takes a big move from that non-farms, but the Japanese yen pretty stable after that. I'm liking that. I'm liking that. So, yep, only on Friday. Now, I was hoping to have something like a really good basic GUI to show you guys today, but the GUI part in Rust is really hard because the frameworks change so often. All of the examples are messed up and things like that. I was actually, man, have you guys tried ChatGPT 5? It is. So it seems like that in general coding overall, that ChatGPT 5 brings it up to about the same level that some of the other like Claude and Gemini were. But there's something different about it too. It's like it understands what you want and tries harder to give it to you or something. But it still just absolutely sucks at building Rust. So yesterday I was like, oh, let's test this and see if it'll vibe code it. Nope. It did better. It did better than the other ones, but it still couldn't get the allocation working. But I just need more time to get it. But what I did do, I'll explain to you. I focused on the Python part. So I've got Rust code. It loads up Python files. There's all this stuff about it. So apparently Python has something called the GIL, the Global Interpreter Lock. which basically prevents you from having like truly parallelized Python code. Only one Python file can be using the interpreter at a time. But they've introduced things in the most recent versions of Python that basically allow us to do what we want to do. So it's like, oh, the timing is right. So I think like the highest risk part of the project, we've squared away. It's okay. So now we're dealing with the second highest risk part of the project, which is building a GUI in Rust kind of sucks. Could we maybe do it in a different language? I don't know. Because the thing is like, well, like we could do it in C#, but the GUIs in C# kind of suck too. Well, they don't suck. They don't suck because it's hard to make them. It's just there's like not a consistent framework anymore. Do you know how to scalp the DOM? Sure. Well, so okay. I can teach you. If you go and you watch my order flow video series that I have here on the channel, you just go to my main channel page and there's a playlist on there, one of the ones listed. And I go into what you're actually looking at on the DOM, things that you tend to see, and the empirical information that we have about, odd behaviors then, and you can kind of potentially take advantage of. But I always have to kind of temper things. If you think that you're going to come in and you're just going to scalp for ticks on the DOM and that's going to make a living for you or something like that, probably not going to work. Usually you need to combine your reading of the DOM with some other edge. In my case, understanding the market, the news, the things that are going on, and being able to predict what the institutions are going to do before you can actually see it on the chart or on the DOM. So don't sleep on that other stuff. I guess I don't know. I don't know how to present this to people. I need to get like a pipeline to get people into the thing. But like you've got to read the news every day, come in, look at your news squawk, look for things that are, predict order flows. That is probably the biggest edge that you can develop as a retail trader. And the DOM really helps you build that edge, because when you have the DOM, you actually understand, you can actually see what's going on the screen. Because here's the thing. This whole thing is set up to screw you over. When you really think about it, the market exists so that people with the information or the capital have the liquidity to execute into. That's why the market exists. And in order for those guys to be able to make their moves without like the market just going completely crazy, there has to be a lot of noise. So they want there to be noise, right? And that's why, generally speaking, you come into the market and you try and execute, because people have all these ideas that's like, it breaks a new high and it's going to come over here and then it's going to reverse, and that's how they fake people out. Nah. I mean they do fake people out, but here's what they do. It's really more like rock, paper, scissors, except for that they get to always see what you do first. Right? You go rock, paper, scissors, and you do rock, and then they wait a second and they go, okay, they did rock, so I'm going to do paper, right? You'll never win in that situation, right? But there is this one situation where every once in a while, not most of the time, but every once in a while, they have to go rock no matter what. Like they would really like, you go paper, they would really like to go scissors, but the way that their fund works and everything else, they have to go rock, right? So if you can predict what they're going to do, because you know how they work, then there are small windows where you can predict what they're going to do and you can take advantage of them, right? I've been talking to ChatGPT because it's like obsessed with the trading platform idea. But it talks about, I don't know, doing ChatGPT-ish things. But one of the things that it said one of the things that it said that I thought was really, I really liked, was it said, don't be the signal or noise, be the carrier. It's kind of like, if you really want to really make money in the markets, you have to be doing something really innovative that completely changes the way that the market functions. Anyways, let's see here. Wow, by the way, the viewership started out pretty strong. Thank you, guys. Man. Did video break? Yes, it did. You guys back with me? That has never happened to me before. Wow. Like, welcome back. Thanks, Paul. The computer completely froze and I had to completely restart my machine. Can you believe that? That has never happened. That is crazy. What would cause that to happen? It's really troublesome. That really bothers me. Okay, of your Jigsaw DOM columns, which configuration shows the actual buyers and sellers? Okay, so the name of the column in Jigsaw is called current trades, but it's the middle. My doppelganger is present. What are you talking about? Other people is Johnny Sims here? I agree with most of your thoughts on scalpel throw, so thank you for sharing. I was just curious to know what your thought, as I have spoken to a few scalpers that just scalp the action tick by tick successfully. Well, so it's kind of then, if you want to kind of like dive into like what might they be doing, sort of a thing, then there's a couple of questions that you can ask them, like, are they just taking one tick, for instance, and what instrument are they trading? Because there's a lot of people that they're quote unquote scalping the equity indexes. You're hearing 2 voice feeds? Really? That might just be you, Gun Driver. Yeah, maybe refresh your browser page. Okay, so first of all, where are we at here? Okay. I'm gonna restart the platforms. They scalp treasuries. Yeah, so I have found personally, like I can scalp for a tick and do pretty okay for a while. And then what happens is you'll take a loss that has a lot of slippage on it. Something like that. Right? So I don't know. It's kind of an iffy game. There are definitely some things that you can see on the DOM that have like a really high probability of you being able to make the tick. But those ones we're not very competitive with. So loading back up okay here? I think we're okay. Well, let's get the music back. Well, first we got to start voice meter. I'm super scared. I've never had this machine just completely freeze up like that. There we go. It was so weird because everything froze. Like, I could see OBS wasn't updating or whatever, but the music kept playing. Spotify kept going for some reason. So I don't know what was with that, but. Okay, so where were we going? Okay, yeah. So, the columns question. So if you come in here, what are you doing these days? I've just been working on the platform every day. So if you come in here to settings, and you can pick which ones that you want to see. And the current trades columns are the two that you care about. And we're talking about basically these in the middle here. Yeah. So yeah, you can get some situations where basically like what I look for when I'm doing this sort of a thing is an area where the bids are really low all around. So like right now at 112, there's only 500, 600 on the bid. So if I hit into that with a market order, if I hit into that with a market order, there's a pretty good chance that it's going to tick up. It's much more likely at least to tick up than it is to tick down. But sometimes you'll get into these areas where every time that it ticks up or down, the next price also pulls. So it would be like you hit into it at 12 at evens, and it ticks up, and then 0.5 pulls, and then that also ticks up. And that's where you can get like the easy fill. Right. Or even better yet, like the bid is really low here. So you get filled on the bid, and then maybe it ticks down a little bit, but then it ticks up and that pulls and that pulls. Basically this place where you can just get easy fills, because otherwise it's like you're waiting in line. 3,500 people have to get executed first, right? And if I can do that in a situation where I have a pretty solid idea of what direction it's supposed to go, then you can pull a tick. And there can often be, I think if you're really looking 2, 3, 4 opportunities like that a day. And granted, we're talking about something where you only take 1 or 2 ticks. Right? But again, the problem with that one is that if I do that and I put a bid out at 31.5, and they do actually fill me, and then the 31 pulls, and then the 30.5 pulls, and how many is it down is it going to go before you bail on it, right? Well, so you should have a stop, right? You get in at 31.5 to have your stop at 31, but then if you put a stop in where like any volume trading at 31 will trigger your stop, then the chances of it ticking down in at least one contract going off at 31 is really, really high. So now you're basically, it's a 50-50. So that doesn't really work. So then you could say, well, I could use a volume stop. Could use a volume stop and only hit into it if it gets below 500 or something like that. But then what happens is that situation where the 31 pulls and you're going to hit into it, and then everybody else might execute before you and you actually end up hitting into 30.5. Or so then you say, oh, okay, well, a regular volume stop doesn't work. Let's do a volume stop limit. Okay, so then that happens and you end up with your limit order at 31, and then some major trend comes along and your order doesn't get executed on the other side, right? So there's like high risk of slippage, essentially, when you're dealing with like one tick like that. The slippage matters a lot. And more broadly, like I try to go for like, I'm usually getting 4 to 10. I'm usually getting 4 to 10 ticks in ZN. And you know, I can, if I can pick up a tick on each side by being able to use limit orders and just kind of knowing the right spot to get in, like that helps so much, man. That one tick on each side, right? And then the split side is if you're losing a tick on each side, like in the situation that I just described, it just sucks. It just doesn't work. So that's kind of the issue with scalping for ticks over here, right? And generally speaking, that's the sort of thing people are doing when they're talking about that. But if I'm going for 4 ticks, you know, I can kind of like, I can take it in here. I know that there's some flow coming later that should take us 4 to 10 ticks up. And then if it doesn't do that, well, okay, I can give myself like a 4 tick range here that I know, like maybe it's not happening yet. They're going to play around in this area. But if they go further than 4 ticks, then I know that like the flow that I'm looking for is not happening. So I can get out of that very, very quickly. So when you change that, then it really turns into something where, okay, I can have a real edge on the upside because I have something that tells me that those orders are supposed to be there, right? So if I'm right, then the orders are going to come. It's going to go right away. And if I'm wrong, that, you know, I only have to wait like 10, 15 minutes to see that it's not happening, and I can potentially get out at a minimal loss, right? So now you're creating a situation where you can extend your winners and you can limit your losers and really, really develop real edge, right? I almost find scalping for ticks easier. Well, I think that scalping for ticks will always seem easier because it's faster, you know? You can do it more often. You don't have to sit in it as long. But the problem is it takes a lot longer for you to see if you really actually have edge, you know? The yen continues to sell. Yeah, there's something weird going on in the yen. There was like a big spike up and it's coming back down now, and it seems like the treasuries are falling with that. You say there's a guy in ZF pushing the market down? It looks to me like it's just falling in correlation. Actually, so here's how I really like looking at cumulative deltas for these sorts of things, right? Granted, cumulative delta is imperfect. What we're getting right now, well, since we started at least, you can see ZF, it's kind of sideways. ZN, kind of a little bit sideways. There was a big sell right here, but it's not a huge still. But over here in ZB, you can see the sell, right? And look at what's happening with the spread. The spread is mostly up, so we are still in a steepener. So it looks like what you're getting is actually the Japanese yen is moving, and so the treasuries are moving in correlation with that. And when that happens, the robots all reposition themselves, and you don't actually see a lot of market orders go through. But you're also seeing that because the treasuries are in a regime of steepening, the ZB is where it sells off. You see active selling in ZB, and the other ones kind of stay put. So, but that's just like the bigger picture. Yeah, because to me, unless I see a change in ZN, in cumulative delta of 10,000 contracts, it's not anything significant. That makes sense. It's a small algo at 26.5. Oh, maybe. So let's go into some of the data. Yeah, what do you mean see algos? Well, I mean, you see algos all the time. The question is it really something that can predict something or not, right? So one of the strongest, most proven empirical properties that we can see in order flow is that there's autocorrelation of order flow sign. So if I come in here and I see a market order at 30 half, I know based on the current bid, best ask, because the current best bid is at 30 half, I know that if there are market orders going off at 30 half, that those were sells. Of course, so I have to monitor that best bid, best ask constantly, and that can kind of be a little bit offset from my feed that's giving me the market orders. So there can be a little bit of inaccuracy in there, but generally speaking, okay, right? I can tell whether it was a market buy or a market sell. And we call that signing order flow, right? So if it was a market sell, then it's negative, and if it was a market buy, then it's positive. Okay. So what they're saying that they're autocorrelated is if I'm seeing that there's a lot of market sells right now, there will tend to be a lot of market sells in an hour. So the actual statistic is if I pick any random order right now, and whether it's a buy or a sell, and then I come back an hour later and pick another random order, they will be the same sign 0.5% more often than even. So that seems like a teeny tiny little edge, but it's actually, when you think about it, it's actually huge, especially when it's like it's for an hour. What's with that? Okay. So here's this aberration. So then scientists, well, researchers, let's call them researchers, try to figure out why that is. What's going on there, right? And a lot of people say, well, there's a lot of selling right now. Everybody's going to jump on the trend. They're going to sell too. By the way, we are now crossing the threshold where the selling is significant. But that might be what, often when you get a move started by a currency, you kind of see people get washed out towards the end of that trend. So I don't necessarily see that as something making me want to take a trade right now. Right? Anyways, so a lot of people say, well, I'm selling because I see other people selling. So maybe that's why it works. So what they did is they took models that are kind of similar to the models that they use to calculate nuclear fission. One atom does fission and splits, and then the neutron flies off and hits another atom, and that causes that one to split. And how dense does things need to be until you get a chain reaction, and like what does that actually look like, right? And so they use those kinds of models on the market and compared it to the actual live data that we see. And what they found was it did not match the market data at all. They were not able to duplicate the stylized behaviors that we see, like the sign of order flow being highly correlated. They couldn't see it. So back to the drawing board. And one idea was that it's caused by really, really big orders. So I could come in and I might want to buy 100,000 treasury contracts. Like that seriously happens. That's, I know for a fact, in fact, that like an average size meta order in the treasuries is like 60,000, actually. Because that's what they were doing when they were trading when I was at the bank. Okay. But, like really big orders can be hundreds of thousands. Okay. I can't buy 100,000 contracts right now. That would move things up like 20 points or 20 ticks, right? It would be crazy. So the reality is as much liquidity as it looks like. You look at the liquidity here in the treasuries, you're like, wow, 6,000 contracts at 29.5. That is a lot. That is a lot, right? Compared to the amount of money that institutions have, it's actually not that much. And so the reality is that practically every major institution that has to come in and execute in the market, their liquidity needs are greater than the liquidity provided, which is really crazy to think about. How do they execute? Well, you have to split it up, right? You can only execute a little bit of it over time, and over the course of the whole day, then you can execute 100,000 contracts, right? And when you do that, you have less impact. And they've actually done a lot of studies on this to say, like, how big is my order and what's the impact? And they find that it follows the square root law. So there's actually kind of a point at which you're executing so much into it and other people get involved and other things happen, and it kind of like makes it easier for you. Like, your orders don't push price as much. So the larger your meta order is, it's kind of like diminishing impact. Kind of interesting, right? Okay. So when they started looking at this and they said, okay, if somebody's coming in here and they're executing all day or whatever the deal is, what does that look like? And then all of a sudden, these stylized behaviors like the autocorrelation of order flow signs and the square root law, all of a sudden, they're able to explain them. Okay. So our best explanation for why we see trends in financial instruments on short time frames is the impact of really large players executing really big orders over a long period of time. Okay. So that's why I say the thing that you're really looking for is the signs that one of those guys are active in the market. That's the thing that's going to allow you to come in and buy it and have it go 10 or more ticks. And honestly, when you pick those, if it's a really big one, it can go all day and you can just hold it all day and it's the easiest trade in the world. Right? So what would be some signs, though, that that's happening? Is kind of the key. Well, so the first thing is you really want to know that it's going to happen before you see it. You really want to know, like, how does the institution behave? A lot of it has to do with time of the week. You're going to see these are much more common Tuesday, Wednesday, Thursday than they are Monday, Friday. If you see one on Monday, it's a really, really big one. Fridays tend to be rare. I'm not expecting to see it right now. They often happen because of the time of the month. Okay. They tend to try and avoid news. They want to like wait and then use the liquidity and activity that gets generated from the news to execute them. There's some other things. If we're talking about the DOM itself, a couple of things that we're going to see. One is, if it's a really big one, they will start by stirring the pot, which is to say, you'll start seeing weird stuff. You'll start seeing volume trading, but it's really going. It's like really churning. It's really churning, right? That's a sign that they're stirring the pot. They're kind of getting the market riled up so that liquidity will be there for when they start the trend. Okay. You're also in the early stages of it. You're going to see refreshing. You're going to see really big icebergs. Like if it was a buy one right now, right? You'd see they're hitting into 30, they're not able to get through it. Right? And then what happens is they have a certain amount that they want to acquire passively. And once they've reached that, they're going to move it. So you're just going to see all of a sudden tick, tick, tick. Right? And when that happens, the robots kind of figure it out and start pulling. So then that's the next thing is that the robots start pulling. Now, the issue is that when the robots start doing that, you probably already have like half the move already done. So like we find very often at that point it goes tick, 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 and you're like, oh, that's it. And then you get in and then that's like the end of it. Or like it does go a little bit further, but then it comes back and, you know, you try holding it for a long time and it just doesn't go. Right? That's the sort of thing that happens. So, and then what I will tend to see, if it really works out, what you'll tend to see is a chart that looks like this, where this follows the square root law, and this is a square root law, and this is a 3/5 law. So basically, this ends up being 2.5 times in length compared to this. Like the time that it took for this to happen, this is 2.5 times that time. And then when it's over, they do another leg. And they can do 3 or 4 legs in a day. Usually this actually ends up being about 45 minutes. Between 30 and an hour, but it averages out to be 45 minutes. That's a pretty good rule of thumb. 45 minutes. Okay. That's when you got a really big meta order coming. Right? And that's the thing that we understand from the research that there's the strongest evidence for. Okay. So you could come in and you might see some sort of weird pattern or algorithm executing, and you might say that means X thing is going to happen. I'm not really aware of ones like that I have really strong evidence for. It doesn't mean that they don't exist, right? But I would argue you really want to watch for the big meta orders. Almost everything else that you're seeing in the market is really just noise. Because what it comes down to is, like, there might be other signals, but the amount that you get on those other signals is less than the noise, right? Like the noise in ZN here is about 4 ticks, tends to be about 4 ticks. So if you're taking 1 or 2 ticks off of something, right, you're taking something that's less than noise. How are you going to know that there's really an edge there when your edge is smaller than the noise? Well, it's possible, but you have to be taking a lot of trades. I don't know if that's really practical for a retail trader to do. I know. I guess one of the bigger problems is that the traditional kind of like day trader like scalper strategies really is market making, where you have orders at like literally every price, right? And if you're just trading one lot or all in, all out, that kind of limits your flexibility, right? That's why I personally, I go for try to identify those trends. Okay, so if we see on the passive side, for example, 5,000 contracts, but see 750 market orders, what's happened to the difference in between? That's a good question. So if we see 6,000 right there at 29.5, and if they were traded down through it and only 500 traded there at 29.5, that is definitely something to pay attention to. Now, it could mean that the market makers are just pulling their liquidity. Okay, like there tends to be a bit of volume, like as you have a trend going, there's like volume gets rolled out in front of it. And so that's why, 2 or 3 ticks away, there's usually a relatively large bidder offer. And there's also a relatively large bidder offer at the extremes, like this 29.5. That's probably why that 29.5 is there, right? If we get to those and then they just completely pull it, well, that's kind of tells you something about with the way that the market maker sees the market. But what is actually often happening there is they're actually converting it into a refreshing order. They're actually saying, okay, I was showing like 4,000 contracts there, and that's what was making it stick out. But now I want to only show 200 contracts at a time, right? And so if you see it bust through and it just keeps going, that's the trend. Okay, cool. But if you kind of see it play there a little bit, that is often somebody saying, well, I do want that, but I'm worried that I might have a hard time getting executed. So they convert it into a refreshing order, and then you do eventually see it trade there. So like right now, if we were to come down and trade 29.5, it wouldn't surprise me to see it pull, but I bet you that we would still trade more than 6,000 contracts at that price overall in the end. So it's kind of like it pulled, but it didn't matter, right? Versus it pulled and then we go down here and we're at 26 and you go back at 29.5 and you still only see 800 contracts traded. Then oh, okay. Right? Now, and a lot of that comes into the spoofing thing, but the spoofing is not as common. Okay, what effect do large orders even have when they're executed off exchange in a dark pool, though? So, dark pool trades eventually come to the larger market. So, the way that a dark pool works, a lot of people think that the purpose of a dark pool is to execute a really large amount without impacting the market, right? Well, it kind of is. The reality is that it still has an impact, and that impact is pretty much the same as if you executed it optimally over here. It follows the square root law, essentially. Okay, because the way that it works is the firm that wants to buy or sell a ton, right, will say, okay, I want to buy 100,000 treasuries. I don't know if there's really dark pools for treasuries, but let's just say, for example, that it was treasuries. I want to buy 100,000 for treasuries. And then there's these algorithms that say, oh, okay, they want 100,000, then you get this price. And the way that they calculate that price is they use the square root law to calculate how much it would affect the market if they executed it out in the market, plus a little bit for them to make money from, right? And then if the deal is done, then what that algorithmic trading firm does is they turn around and then they execute that on the market with all of their tricks and everything to reduce their execution. And if they can execute it more efficiently than what they traded for it on the dark pool, then they make money. Okay. So essentially a dark pool is really just a way to more easily facilitate doing a block trade, essentially. So you're not going to know like at the exact time that it happens, right? You do get like reporting at the end of the day about what happened on the dark pool, but what's going to happen when that transaction happens on the dark pool is that the other side of that trade is going to come in and execute it. So you will still see it over here. A problem is that alignment with a meta order requires quick entry. Well, so when you get a meta order like that, you know, usually the amount that it goes is usually like 15 minutes, 10, 15 minutes. So you do have some time to work with. But if you don't know that it's coming before it happens, then yeah, you really have to be in early, and that kind of requires you to know it beforehand. I'm not gonna say you can't make it work otherwise, but what are the off change? I believe that the dark pools have to report their transactions at the end of the day. But the important thing to understand is that executing on a dark pool does not free large executions from the square root law, and eventually will result in order flow that comes into the larger market. Unless it just so happens that there was a really, really big buyer and a really, really big seller, and they just happened to meet and negotiate. Come in the middle, right? Then that's different. And then whereas you would have seen this furious back and forth in this range as they realize what's going on and start trading back and forth, right? And you could maybe take a tick off of that a couple of times. You know, it's happened on the exchange. It's already done, and then you don't get a chance. There is that. But I think it kind of comes down to, so here's another thing. Is with this whole framework that I'm providing you, just remember that it's not necessarily informational content. Like the fact that we moved up or down. This morning we moved a little bit down. Was it enough for a large meta order? Yeah, it was. Okay, so we had a large meta order sell, right? The traditional technical analysis way of looking at that is that every movement in the stock market reflects something about people's psychology and what people know. So there's like this assumption that every movement is a reflection of some sort of informational content. And the reality is that there's a dozen different reasons why somebody would have to execute a large order of that size. And some of them have absolutely nothing to do with what that participant's view of the market is or what they think is going to happen in the future. Okay. So the informational content of large meta orders is dubious at best. And people that are stuck in the technical analysis paradigm, they're concerned about dark pools because that's like, that's informational content and I'm not going to see it. Well, first of all, you are going to see it because the flow is eventually going to make it to the exchange. It's just maybe it's going through a block trading firm first, right? And two, it doesn't actually have any informational content. That's why you can't come in and say like, oh yeah, I did this and it did this and that means it's going to do this next. It doesn't work like that. It doesn't work like that. There are patterns, but the patterns are really results. It's more like if I'm going to go and execute a large meta order in the market and like here are the optimal ways to do it and everything, and I know that when I execute it that on average it's going to have this, it's going to do this, right? That's the pattern. So it's really you get in the trade and then you will see the pattern, not you see the pattern and then get into a trade, right? Yeah, guys got it backwards. But like I said, I don't know why, but I think it has to do with some things that ChatGPT keeps saying to me. But because I think at the end of the day, I'm really more a guide trying to help you avoid some of these kind of toxic flows. Essentially, that's what it is. So you have to understand that this is not set up for you. I think that people have this idea that the market exists so that they have a chance to try their hand at mastering the market and getting rich. No, that is not why the market exists. The market does not exist to give everybody a fair chance at becoming rich or some nonsense like that. The market exists so that people with the knowledge, or when I say the knowledge, I mean like they know something about the supply or demand of the economy. People with the information and the money so that they can come in and execute. Because if there wasn't a market and you had this ton of money and you needed to put it to work, how are you going to put it to work? You can't. That's why the market exists. It's the only reason that the market exists. And this is the whole foundation of capitalism is essentially the real problem is there are people that know things about supply. There are people that know things about demand. And normally, before capitalism, there was no reason for those people to talk to each other or share information. It's in their best interest to keep it to themselves. Even in communism, they would keep it to themselves. And this creates what we call a Nash equilibrium, which is basically it's a situation where neither side has any reason to change their strategy. So they're just going to keep their mouth shut and not do anything. And then the information never gets shared. So what did we do? We created a market. Now, that person, if they know something, they have an incentive to come in and buy that asset and make money from that asset going up. And in so doing so, that information is shared to the rest of the market with all of this other noise that's going on, right? That's what the market is really about. That's what capitalism is really about. And basically what it's come to is you have to have a central place to aggregate all of that information. Now, yeah, Schwab. Ray says his Schwab is up. Now, some might ask, well, what about AI? When we have AI, will we not need a market anymore? Well, we will. You still need, because there's still supply and demand. There's still like some people, some robots that want to put all of our resources into building more compute power. And some robots that say, actually, we need to put some resources into food. And how do you sort those things out? That's how we sort. That's what a market is for. And the robots, they might have a different kind of market. They might have a way to really, truly just aggregate all of the information into one central location and then use slightly different algorithms to determine what would be like the most effective, efficient price, and then distribute it back out to all of the participants, right? So the actual mechanics of the market might actually change, but it's still going to be something that we would call a market, because it's still going to be like one central place where all of the information comes together, right? So you have to, I don't think that it is possible to have a really large, vibrant, functioning economy without some form of a market. This is the thing that I think everybody misses, because basically what happens is the system, it wants to perpetuate itself, and one of the ways that it perpetuates itself is by distracting us with things. And the best distraction, I tell you what, man, I'm sure I'm gonna trigger a lot of leftists with this, but the biggest distraction that they have is communism. They know communism doesn't work. They know that it is not a viable replacement for capitalism. They know that it is not really a threat, but people love to talk about it. The interesting thing is that socialism, communism is completely different, right? We just talked about the market. Communism is obsessed with labor. Oh, we're not paying laborers their fair share. Well, yeah, because it happens on a market, and the market's not perfectly efficient. And some people have an advantage of the market over others. It kind of sucks, but that's the thing. So their idea was, well, we just get rid of the market. That doesn't work. You have to have a market, right? People complain about modern capitalism, but the truth is that their problem is not that we have a market. Even the Chinese have a market now. They've figured it out. This is really the only way to do it. The problem is that there's all of these other things that are built on top of it. Like, what most people don't like is what I would call corporatism, right? The way that corporations are set up and the way that the rules are right now really favor corporations compared to labor. And that's why you're having a lot of the problems in society that we do right now. But instead of people saying, maybe we shouldn't have stock buybacks, that shouldn't be allowed, maybe we need to look at the way that the boardroom is structured and the way that the rules for that work and the way that the rules for, like, you know, having shareholder votes and things like that to kind of tilt things a little bit more in favor of the public versus the private well, not just the private shareholders, but especially the board, right? Because it's really when you think about like the rich class, it's really the boardroom class. But nobody's talking about that stuff. Nobody's talking about that stuff. They're too obsessed with communism, labor, yada, yada, yada. Oh, robots will make everything. No, you still have to have a market, man. Might be a different market. Might be a very, very weird market if labor is no longer valuable, but there will still be a market, some sort, somewhere. Now you understand the whole gig. You can come back and you look at it, you realize, okay, this is not here for me to make money. I'm kind of doing something that shouldn't be possible. How am I going to do that? Do you really think that they're going to structure it in a way that, like, you're just randomly going to make money? Well, you could randomly make money and you'd be the lucky one if you're lucky. But net, you do it long enough, you're going to lose. Unless you know what the people that the market are really for, those people with the information and the capital, if you know what they're going to do before they do it, and you ride their coattails instead. What are your thoughts on analyzing market microstructure, analyzing sub-second changes in level 2 or tape? So there are things that you can find in the flow. I mean, like, I think that there's a lot to do there and unpack, but it's stuff that you're probably going to have to do algorithmically. Okay. But I've seen a lot of evidence that you go and you pass the order book into a model, like what do we call this, into a neural network, and it can find very effective short-term signals. But those signals, and could you potentially see those signals yourself if you train hard enough? I think that we do kind of see them to some extent, but they're too fast. They're too fast for us to really execute on. So it's really more base, right? It's really more, we want to get a feel for how it works and kind of let our mind sort, because, you know, the way that a neural network works, you don't necessarily understand how it works. It just gives you the answer, right? So that's building the intuition. So yes, watch the order book, build that intuition. Just understand that in our current world, being able to execute and make money off of purely that is not very realistic. So what you're saying is, Sotra, you have to play like those people. Well, I wouldn't say it's like play like those people, but you have to but I think that there's more edge in understanding those people than there is, you know, playing this technical game, essentially. Like what happened is we've all been conditioned to try and use technical analysis because we heard about people making money purely. What it used to be like is, this is what happened, is like in the old days, yeah, technical analysis was always there, but it was kind of a joke. It was kind of like the professionals, they didn't use it, they didn't think that it worked, right? And then Jesse Livermore came along. And Jesse Livermore was the first one where people kind of said, oh, maybe you can make money from, you know, at technicals, essentially. The problem is that I honestly think that he was just a really big gambler and lucky, because in the end he committed suicide and was broke. Like he got really big, but in the end his strategy was not sustainable. Right? Things kind of progressed in the 50s. There was a couple of developments where they started to develop these things. And what happened was, on a daily basis, they actually did kind of find some certain tendencies and so forth that they were taking advantage of. And then other people came in and started trading them, and they got removed from the market, right? Then you come into the 80s, and they started taking a more sophisticated approach to it. Okay, I'm going to analyze this over a whole portfolio of instruments and create this portfolio that takes advantage of the tendency for assets to rise over very long periods of time, to trend over very long periods of time, right? I can take advantage of it with a portfolio. And then I can use all of these other advanced methods like Markov models and machine learning sorts of things to really filter out the noise and get really, really good, you know, signals about which ones I should get into and out of, right? And so everybody kind of saw that, and said, so the thing now is to make money from technicals. And at the same time, it was also a really big thing to show traders on the floor on TV, you know? So we were all conditioned to try and become technical floor traders, essentially, to become locals, is what they call them. And the problem with that is that two things happened. One was that those big quant firms, first of all, what they were doing was very different from what we understand, because they were doing it on daily charts and it was much more sophisticated. And that industry grew really big. So a lot of that edge is already taken advantage of, right? And then the other thing that happened was robots took over. The locals got replaced. So you have a bunch of people coming in and trying to play this game that essentially doesn't exist anymore. It really doesn't exist anymore. Now I will say, here's the one place where I kind of see an opening for us. Is that it used to be the same with order flow. When I came into the market, order flow was much more effective than it is now. And it was basically like from that time period from, let's say, 2008 to 2018 or so. Like, order flow was a lot more effective than it is today. And that was the point at which it became common enough in the market that at least here in futures, it's not like an explicit advantage anymore. Like, it's still useful if you're going to trade futures. I really think that you want to have it. But I think that it used to be that if you were able to get on those platforms, those really, really early platforms, or build your own, like, you had a real advantage, right? But that is not the case in stocks. Hardly anybody is using that stuff in stocks. And there's probably more room to take advantage of that sort of an edge in stocks anyways, because of the way that the spreads are, and there's so many of them and things like that, right? So in a year, if they make this rule change, changing the pattern day trader rule, and we can get good order flow data through DX feed and get that whole thing working, then I think you could have a strong edge using order flow on stocks, right? It's understanding the metagame, right? So many retail traders, they don't understand the metagame. They're behind. They don't realize that the game that they're trying to play ended years ago. What do you think about analyzing trading from a purely reward to risk ratio? So what you're going to find is that the market is extremely statistically efficient from a risk reward point of view. So if you come in and you say my R factor is equal to, my average winner over my average loser. So like I want my winner to be twice as big as my loser. Then you're going to find that the percentage chance of you winning is going to converge on being equal to 1 over 1 plus R. So what is 1 over 1 plus 2? That's 1 over 3, 33%. So on average, if your target is twice as far away as your stop, you're going to win 33% of the time over a large enough data sample. And so this whole idea that like all you got to do is have a risk reward ratio that works out right or whatever, it's nonsense. The percentage will always compensate for it. Of course, that does kind of help you analyze your strategy. Like if you can go into your statistics and you can say, I'm making twice as much on my winners as I am my losers, but I'm actually winning 45% of the time, then maybe you have something, right? That's how I tend to perform when I'm doing well. When I understand the market. Yeah, the issue with the way that I trade is it's dependent on you knowing what the institutions are going to do in that situation. Sometimes I would say that largely during this kind of like trade war situation, it's just been chaos, and you can't really make heads or tails of it on like that intraday basis, except for a few isolated situations where there was certain news that you could jump on a trend or whatever. But I was able to realize that, and I've kind of stayed out and haven't really traded much. Now, I kind of wonder about where we're going next, though. Well, so what do we know? One thing is that a year from now, they might change the pattern day trader rule so that you don't really need very much money to be able to pattern day trade stocks. So if that happens, then probably all the retail traders that are trading futures are going to leave. I think you'll still see a lot of people trading futures with like the prop firms. The prop firms are still going to be futures based. That's still going to be a really huge portion of people. But people that are like funding their own account, I think they're all going to go to stocks. And I think that's a pretty big change for our channel. I think we're going to have to work more in the world of stocks. And we can use our order flow there. So there's one thing that we know that's coming that we can take advantage of, right? Then the other thing is maybe there's going to be a recession. What do you think? I don't know. When I saw the news on Friday, I was kind of like, oh man, there's going to be a recession, isn't there? Well, okay. It's not quite so clear. One of the things that I find really difficult and frustrating is we've been saying this whole time, right? The economy is not as strong as it appears. These people are saying the economy, like the Federal Reserve, the economy is really, really strong. Well, we've said the whole time, no, I think there's some real weakness in the market. You just might not be seeing it in the top line numbers because it's mostly tech workers, but I need an interest rate cut, right? I don't think that I ever had the balls to say, well, we're going to have a recession, or like this number is wrong. It's just going to be straight up revised, right? But so we kind of knew what happened, but did we have like the balls or the wherewithal to build the trade out of it in that situation? No. So do we have it right now? Do I think that we're like really going to go into a recession? It's not so clear to me. We're going through a period of weakness for sure. We're going to cut in September for sure. But does the economy go into a recession, or are we able to recover from here? Amir says, no, I don't think anymore. On a recession or not? I don't know. It's a tough call. It really is a tough call. Main Street is in bad shape. Yeah. Like the thing that I like just upsets me. That upsets me so much is the people that would do well in the economy, the upper middle class people, tech workers and middle managers have just been decimated across the board. Well, we're getting a pretty strong move down there, by the way. They finally broke through that big order at 29.5, and they're pushed, often when you do take out a big order, they go a few ticks more. It looks like we're getting that right now. They're hurting. And then where is all of the job growth? It's happening in industries that you don't want to work. Like there's a lot of job growth in healthcare. Yeah, they're making a lot of jobs in healthcare, but you know what? Like those are hard jobs. They don't treat you very well. They don't pay you very well. So do you really want to go into healthcare? Kind of seems a problem to me that healthcare is like the fastest growing sector right now. I don't think that's a good thing. Yes, this is a good question. Stephen Moran is going to replace the other Fed member that is resigning, at least until the end of their term. There was a lot of speculation for some reason, which didn't make sense to me. They were saying that whoever Trump picked would be the person that they would make chair. That always seemed like a long shot to me. Because the issue is I really don't think that you can just take anybody and then immediately put them into the Federal Reserve. Like there really is a lot of institutional knowledge that is required to be able to do the job effectively. And when you do have people that are put in there that they weren't already on the board, it's usually because they were the Treasury Secretary. Okay. So this idea that they're just going to appoint somebody new, some economist or so that's not in the Federal Reserve System at all, and then 6 months later he's going to make him the Fed president, very unlikely. Zero Hedge thinks that it's going to be Waller. I think that is probably a pretty good bet. He has the institutional knowledge. He has kind of been in line with the administration, and he's been kind of campaigning for it too. So the poly market has kind of all of a sudden decided that's the most likely one. I haven't heard, we were supposed to know like any day, and it's like the end of the weekends. We still haven't heard anything. Maybe it happens today or tomorrow. Like, I wouldn't surprise me to see it happen over the weekend. A lot of those announcements are made over the weekend. Will it change anything? I really don't think so. But only because I think that it's going to be a unanimous rate cut in September. I think that it was always likely to be a rate cut in September. And now that we see that the economy is actively weak, now they're definitely going to do rate cut in September. That offer looked a little aggressive there for a second at 28. It backed off, but it was looking aggressive for a second. Have you ever analyzed the SPY type? There are always these anomalous outside prints that are far outside the bid-ask spread by a large amount. Oh, those are probably options executions, right? You go and when somebody has an option and they decide to execute their options, you will see volume come in on the tape at the price that they executed at. And so you get these weird spikes that don't make any sense. And a good platform should filter those out, but a lot of the retail platforms don't. So it screws your chart up. But that's what that's about. I think there's some other things that can happen that can cause that, but that's the only one that I really know a lot about. You know what? I think not talking every day, because my mouth is a little bit like apparently there's something about talking every day that conditions my body or something like that. Although I do feel like sitting here doing this, I don't feel like I haven't been streaming all week or anything like that. It just feels like a regular day to me. Oh yeah, you're right. Oh my gosh, Amir, how did I not notice that until now? We need to roll over. It's now time to be in queue, right? Oh, that's weird. I thought I was seeing messages while I was changing that, but I look over and there's nothing. What was I catching out of the corner of my eye? Was I just catching the downticks? No, because it hasn't moved here. We should reset it though. We did get another set of meta order down though. I think I would say that fits the bill, even though it's not a huge one. It's really this really more like that. And if you kind of look from like this point here to this point, you're gonna find that that's probably about to. Kind of depends on where you decide that the meta order ended. I think it should say it was exactly at 7 o'clock. So let's see. I think I have a tool to do that. Time extensions. So I don't think that it started from this one. I think that it started from, well, really it was like from here to here. Really the meta order was from here to here. But we go from the start. Oh, maybe it is better with that one. Okay. Pretty close. Pretty close. We'll front angle it a little bit so that it comes out exactly. But you see, they're pushing it, and then there's the mean reversion period, and then they're pushing it again. We're getting a second leg. Oh, this was a leg too. This was a leg too. But we're getting a second leg. And there's not any news or anything, is there? Yeah. Yep, nothing new. So I do think it is. Now, why might that meta order be coming through? No clue. I don't know. Could it just be closing out things for the week? You know, I've never understood the Friday flows very well. But I am starting to wonder if Friday just tends to be a mean reversion day. That, like, maybe you could do a study that says, you know, if we were up Monday through Thursday, there's a higher percentage chance that we'll be down on Friday. That definitely seems to be a thing. Well, no, not that definitely seems to be a thing. That could be a thing. I think we have a reason to suspect that is a thing. Why am I hearing garage? Oh, maybe my wife works today. And by the way, I don't know anything about Stephen Moran. Haven't heard anything about him yet. So. Banks tend to be short. Goldman explains the gold market shock. Yeah, that could be a problem. Disney settles legal dispute with Gina Carano over her firing from The Mandalorian. Really? I always kind of hate it when there's like a big lawsuit like that and they just settle. you know, because you never get the thing to say, you see, they did something wrong. And oh yes, this reminds me, did this thing... I'm gonna do this, put videos up on Amazon. Totally forgot about that. So that's taken care of. Whenever I look at the emails that come from Jigsaw these days, I really don't think any of those emails are coming from Peter. Gold price have a problem. Yeah, well, you know, it's kind of curious. So let's come back and look at the chart of it, huh? Oh, oops, where is it? I mean, there was a big spike in gold for sure overnight. That's a big spike, but it's not actually outside of like the normal volatility in gold, is it? So, do I have a bigger term chart? No, I don't. To see it. So, it's kind of hard for me to say how big of a deal it actually is. Because the thing is, like, Zero Hedge is obviously posting about it, but it's Zero Hedge. They're obsessed with gold and crypto, and kind of silly to me. Well, I was hoping to see if we got some resolution here in the treasuries. It seems like that they might still be a little bit of a downtrend. You're definitely still seeing the volume in the 30-year, and it's still a bit of like a steepener. You're also these waves down in the treasuries are still being accompanied by declines in the Japanese yen. But it was like, notice here that the yen, so like this down move corresponds to, you can see it, that and that, that and that. So the yen recovered, and then there was a second order, and meanwhile in the treasuries didn't go anywhere. So that's kind of curious. Now, on the other hand, like a larger picture, 111.27 is not all that. I mean, come on. We had a big jump. We're back to prices seen at the peak of the tariff prices. So, you know, they can only go so far so quickly. I would like to see I would eventually like to see something like but we'll see. Auctions have played. Yeah, you're probably right, gun driver. There's definitely some interesting things happened with the auctions too. Totally forgot about all that. A little constrained. And then on top of that, we got CPI next week, right? So before I go here, because it is time for me to get going, 90 minutes is just not long enough. There was one day this week where I worked from home and I got to work on my trading platform an extra hour, and that was a big help. That was a big help. I just wish we had that extra hour every day. Of course, I would probably stream. Oh, it's on Tuesday. A CPI is on Tuesday. So, I will stream on Tuesday. Deal? We'll see you guys on Tuesday. And Infonomics provides commentaries on it. Oh, I haven't tried them. I'll have to go look at that. I have seen commentaries from places. You know, Zero Hedge usually has a commentary on them that I think is good enough. Yep. Okie dokie. I will see you guys Tuesday. Meantime, stay excellent.